Sridhar Sivaram joins us, and we won't get into cleaning and personal hygiene and other things like that. I'll get into market right now. Sure. What is your sense?
I think I was here 3 months back and had said that capital protection is what should be the mantra for 2018. I still stand by that. That we had great returns in 2017, and we had huge rally for the larger market, the mid caps and the small caps. We are seeing some correction as far as that is concerned, but it's going to be a tough year given how the macro is shaping up, and also the fact that some of the flows that we have seen in some of the PMSs and some of the other sort of flows which are seeing from the domestic market is ebbing a little bit. So I would still say that one has to be very cautious for 2018. Look at your quality of your stocks, and if there are some mistakes, this is time to correct it. It's in some cases it may be already too late, but it's still worth looking at it and build a portfolio for 2019 and beyond.
So you're trying to indicate that the pain is not over already, even after the 26% fall in the small caps.
So I really don't know whether the pain is over, or I don't track the small caps as closely as some of the others would do.
No, but just a feel of the market.
The texture of the market is not looking good. The way some of these stocks are falling. If you look at even at lower levels at 25-30% lower, also they aren't enough. The volumes are not great. So I don't understand this so well. But the texture doesn't look so great. I would just reiterate that one has to look at the quality, look at your portfolio, look at the quality of your stock. If you think things are not great, it's better to realign. And large cap still looks reasonably better valued than some of the mid and small cap. So I would look for where there is earning certainty, look at those stocks. Maybe build a portfolio for 2019 and beyond, as I said, because even in the large cap, there are pockets which have corrected, and looking like there could be value in some of those sectors.
You're saying PSU banks are a hope trade, and PSU banks is our top theme really this morning with what Mr. Vatsa has said. We were literally talking about the fact that if Mr. Vatsa is open to acquiring PSBs, then a lot of people would be, because if he's talking about privatization of PSU banks, then there would be many takers for the business, right? But your premise of looking at PSU banks is an earnings revival.
Correct.
Please explain that, because
No, it's actually very simple.
When will it come by? And how conclusive would that be?
2018-19 could itself be the big year of earnings, not because of core earnings going up. Look at what is happening to the provision part of the line. So many of the PSU banks have had a credit cost closer to 2.5-3%, and the year before that was 1.5-2%, and you take the year before that, it was also about 2%. We could see the credit cost normalizing closer to about 1.5-2% for this year, and maybe 1% and below for the next year, because so much of cleaning has already happened. So I'm not saying all the PSU banks, but some of the larger PSU banks are surely looking interesting, only because of the fact that I do believe that the NCLT process, even though there are some hiccups, is moving in the right direction. As a result,
the larger PSU banks always gets cornered into just one, which is SBI. And then the
not
rest
necessarily.
Of okay, Bank of Baroda and the likes.
You take the top 3-4 PSU banks, and you can pick and choose from there. I think all of them will have the same story playing out, which is that the earnings will be very strong this year and the next year. Maybe a little bit because of the core operating earnings, but a large part will be because of much lesser provisioning required. I mean, they've had excessive provisioning thanks to the February 12th RBI guidelines. We've seen a lot of provisioning coming even in the March quarter. So I'm not a complete no-sayer for PSU banks, but I don't think this is a structural trade for me. I think it's an 18 to 24 month trade, because I do see earnings growth coming back because of various other reasons, not necessarily because of the core earnings reasons. So there could be a trade here. I know there's been a hope trade. Many of them haven't worked for 10 years. In fact, we were looking at some of the PSU bank charts. Some of them haven't worked for 14 years. I mean, they're back to where they were 14 years back. So
even lower.
Even lower. Some of them. I was just looking at the top 3-4. So
you've been charitable then. Okay, no, I mean, of course, there is a problem, and they've destroyed shareholder value. So I'm going to shift sectors and talk about a sector which, as a house, you track with not a magnifying glass, but even with a microscope, and that's the metal space. when the world was crying for the China correlation in 2015, as a house you bought into metal stocks, and that trade has worked.
Right.
Now the world is crying for a trade war. How realistic is the outlook on metals? Because metals is more like a macro call. I mean, if metal prices do well, companies will do well, stocks will do well. It's very simple. So first you have to get the call on the commodity right, and then pick up the market leader. I'm making it sound simple, but what is your call there?
So as a house, we're not as bullish as we were 2 years back as far as metals is
concerned. Have you sold your metal exposure?
So I can't give you exact details of whether we've sold or not, but generally our bullishness isn't the same because at that time there were less believers. Now almost every research house has a buy on some of these metals. Having said that, doesn't mean that we've sold out lock, stock and barrel. We still like some metal stocks, and we still have metals in our portfolio.
Everyone is also of the view that don't buy consumer staples. These are expensive stocks, great companies but available at ridiculous price. It is like saying silver is available at the price of gold. But is it time to think contra and say, look, they may be expensive, but these are great businesses. They may not give me return in 18 and 19, but if I am here for 5 years, consumer staples, expensive consumer dominated brand owners, they will still make money for me.
Yeah, so I'm not in that, even though fundamentally I'm a growth investor and I don't really care about PEs. But my issue with staples is that I don't find growth. I mean, after many quarters, we saw double-digit volume growth from HUL last quarter. And this is the same for most staple companies, that I don't have a problem paying for growth, but I'm finding growth very difficult there. I would rather look at consumer durables, where I'm seeing growth because India's penetration in some of these categories, be it, ACs or washing machines or any of these durable categories, when you look at the penetration is much lower, whereas in staples in many of the categories the penetration is as not low as when one compares with other emerging markets with similar per capita incomes. So I will still back consumer companies, but not necessarily staples. So I remember in my previous avatar in 2009, we had bought into staples in a big fashion. This is just post Lehman when markets were flying. I remember 2009 markets were up 75%, and everybody was looking at cyclicals. At that time, we had bought into staples because staples premium to the market was at the lowest at that point of time. It always trades at the premium, but that time the premium was the lowest. And that trade worked for 5 years beautifully well because, all the consumer stocks almost, they double tripled in just 2 years. The same safety is not there at this time. Plus the growth itself is missing. We had a, fiscal stimulus also coming that time. So we saw huge growth as far as staples is concerned. That isn't the case right now. So I would still go with that trade, that I would avoid staples as far as possible.
But you do believe that kind of an opportunity is there in the large caps? Because earlier to my question, you were saying that look beyond the already performers in large caps. Where is it that you're finding value?
So some of them are the, the normal compounders who are growing. So
besides that list.
No, besides that list, PSU banks is one of them that I mentioned. Corporate facing banks, which again is a sector which hasn't done well. I come back with the same logic that because of how NCLT has performed, the whole IBC has performed, one has to wait. Again, in some of these cases, the stocks haven't done for 10 years anything. But my belief now is more not because of anything else, but only because of change in law. That we haven't had this law before, and that law is working quite well. May not be exactly the way it should have, because there was a time-bound program and some of the courts in India have taken liberty of extending that timeline. But even if I give an extension of 6 months or 8 months, eventually once this starts working, we will see a significant impact as far as earnings is concerned. So I would look at some of those. And of course, you on a bottom-up basis, you keep getting stocks in discretionary, in, as I mentioned, durables. I am not a big fan of external-facing companies right now, which is IT or pharma. But domestic cyclicals, they are looking interesting, because when you look at the numbers, which is the on-the-ground micro numbers that we are seeing, be it two-wheeler, four-wheeler, passenger vehicle, commercial vehicle, cement, steel. All of them are, coming up with numbers which look fairly encouraging. Yeah. So we are looking at opportunities within this, and there are quite a few right now.
Right. Talking about corporate sector, corporate-oriented banks. We've of course done this analysis last week where we looked at ICICI and Axis Bank's books, and their retail exposure has gone up, almost rubbing shoulders with the likes of an HDFC Bank. you keep that premise in mind. You keep the premise that private sector capex is not going to pick up in a meaningful manner, and the bad loans have already been, they're in the process of a cleanup. Is it a compelling proposition to then look at, to give the premium of the retail exposure that these banks have right now and discount the legacy of the past, the problems of the past?
So I'll add one more to this, which is many of the PSU banks can't lend. So when we are going on the ground and meeting companies, they're saying that we have exposure with XYZ PSU bank. We need money for working capital, we are not getting. So where are they going? They're going to some of these either smaller private sector banks or some of the larger private sector. So there is opportunity right now, even for NBFCs, to take market share right now. So I'm not saying that some of these should get the valuation that the retail banks get, but even a reset to their own historic average itself is a significant rise. Keep in mind that the earnings will also jump. So currently nobody wants to believe that the earnings can move up.
Why isn't the market capturing that?
I think it's a question of it's a cry wolf that we kept saying the earnings will come, it has never come. So I think this time around it will happen only when you see 2 quarters of earnings, not even the first quarter. So I think it's a patience game, and if one has the patience on this, this will reward. But it doesn't mean that I've given up on my earlier favorites, which is the private sector, the retail lenders, which remains my all-time favorite. It's just a question of portfolio construct as to how much of that can you own, and how do you construct your portfolio as far as the other sectors are concerned.
2 years ago, this market discovered a lot of themes: defense, irrigation. We talked extensively about made in India as a theme. Some of these stocks, they got re-rated. I remember railways as a theme got re-rated. Defense related companies, they got re-rated. Where are all those themes? 2014, when there was a change of guard, suddenly this market had 15-20 themes to really bet on. Some good guys also bought some interesting stocks, but somehow there is no fall off. The volumes are not there. Nobody's talking about it.
So we played only the construction theme because when we did our on the ground research, that was the only sector where we saw even the companies saying that we are getting orders. So of all the themes that you mentioned, you missed out construction. In fact, that was the one where at least the ministry has really worked hard. And if you see the amount of orders that have come through, the changes that have happened on the regulatory side to make it easy, I think that's one sector which has benefited, and it shows in the market cap of companies, the order book. So there are good, bad, ugly even there. But broadly, if you have picked your stocks right within that sector, you would have made money. So I would say that is if you do your research right, you may find some of these themes may also work.
This realization in a sense has dawned on me, and it has come very late, that if I look at the outperformers of last 10, 12, 15 years, they're just concentrated around 3 themes: consumers, private banks and autos. And that in a sense is like the India story, the Bharat story.
It's a blind shot.
Yeah, anything which has got to do with these 3 themes, they've done reasonably well. You may have outperformed, underperformed 1 or 2 years, but that's okay. But if your portfolio had autos, it had private banks, it had consumer names, last 15 years you've hit a home run. Is that the theme for next 5, 10 years? You may argue about the stock selection there, but just stick to these themes, keep your 80% portfolio there, don't try to get into cyclicals, this theme, that theme, just have 70-80% allocation to these and then take it easy.
So these are the secular themes, because if you look at why foreign investors come to India to invest, it's because they're looking for growth. So predominantly they're coming here to buy sectors which have the secular growth because of the demographic advantage that India has, and I think that hasn't changed much. So you will have pockets when you have overvaluations and undervaluation, but over a period of time, this theme will continue to work.
So roti, kapda, makan and now gadi, right? Roti, kapda, makan and gadi.
Correct. So that theme has worked. So the other themes that you mentioned, which have worked in pockets, is cyclical in nature. So by definition, they will have ups and downs in their cycles. So if you can play that cycle well, great. Otherwise, broadly, these themes will continue to work over a longer period of time, and I think I'll back that.
So you're saying that 2018 your concentration should be on building your portfolio for 2019. We're already halfway through the year. Is it going to be as concentrated a market within the sectors that you talked about, wherein even within Nifty only 15 stocks will give you return, the rest of the market is going to underperform, or come 2019 you're going to see a more across the board, broad-based kind of recovery play out?
I would say broad-based recovery because of the way we are seeing the micro numbers. So if you are seeing cement numbers improve, steel numbers improve, the entire auto numbers are improving, which means auto ancillary and anything related to that. So there is a recovery that is happening on the ground. So there are technical factors because of which the markets are correcting, or the broader market is correcting. So that is the opportunity for you to build your portfolio, see if there's good quality companies which are also correcting. Having said that, when you buy it, not necessarily this is the bottom. I mean, you could buy and tomorrow it could be down another 10%. So which is why I said that you build your portfolio for 19, do your homework correct. And because the fact that on the ground things are improving, it's highly possible that the earnings growth for next year will not be a pipe dream. It may actually be the number that most analysts are predicting, somewhere in the...
But not as rosy as 2017, would it?
2017 we got rosy markets, not rosy earnings.
Yeah, not earnings, markets, returns.
So that was because of various other factors. But if earnings do come back, then markets are slaves of earnings. So they would follow the earnings. So we've had 3 years where earnings have been very tepid, but markets have done okay. So this, I think, will be a change where we'll get earnings and then eventually markets will follow that.
TCS has become a $100 billion company. Reliance is almost there. In 3 to 5 years, which are some of the other companies which have potential to be there?
See, I will not want to name any company here.
It's a very broad question, whether
yeah,
it happens
but,
today, tomorrow, but we are talking about a large cap becoming mega cap.
I think it will be something from the financial services.
So you don't expect a L&T or a manufacturing company to reach that? I'm just trying to understand.
No, I don't expect.
Okay, so
I think there's opportunity for financial services company to reach there faster because of the huge opportunity that is available within that sector. Whereas for manufacturing sector, they continuously compete with outside countries also, where our edge on manufacturing isn't as great.
It's a rather obvious guess, which we will refrain. But Sridhar, great speaking with you. Thanks so much for taking the time out and chatting with us.